we will continue our discussions of qualitative characteristics of financial statements. As you know, financial statements, if they have to be useful to the users of the financial statements, they need to have certain qualitative characteristics that will make them comparable with other financial statements and then help in arriving at certain decisions. Therefore, these qualitative characteristics are very important. We will be considering some of the important qualitative characteristics of financial statements. For example, we will start with what is known as understandability. Then we have characteristics like relevance, we have got reliability, comparability, then materiality, then faithful representation, we have got substance over form, neutrality, and prudence, full and fair and adequate disclosure, and completeness. These are some of the important qualitative characteristics of financial statements. Let us try to understand each one of them in a little more detail. So let us start with understandability. So what it means is the financial statements need to be able to be understood by the common person who is using the financial statements. It does not mean that anybody without any knowledge of accountancy would be able to understand the financial statements. What is presumed here is that the person who is perusing the financial statements has certain basic knowledge about accounting principles. Once having known the accounting principles, he should be able to understand the financial statements in a better manner, so that he will be able to make informed judgments based on the information given in the financial statements. So this becomes one of the important qualitative characteristics of financial statements. Then we go to substance over form. What it means here is, what is important in financial statement is the substance, not the form. For example, if you have to find out something and incorporate it in the financial statements, what is actually happening need not be incorporated, but what actually it represents, that is to be incorporated. That means substance is more important than form. Then coming to relevance. Relevance means the information contained in the financial statement should be relevant to the users of the financial statements. That means what is relevant only is included in the financial statement. What is not relevant is not included in the financial statements. The more the relevant the information contained in the financial statement, the better it is for the users of the financial statements. Then we have neutrality. Neutrality, as the name suggests, the statement contains information which is free of any bias. That means there should not be any room for subjectivity in the information contained in the financial statements. To the extent possible, we need to bring in objectivity into the financial statement, but of course this cannot be completely ruled out that there will be some kind of subjectivity, because after all most of the estimates which we have to make in the preparation of financial statements will be definitely based on the subjective analysis of the person preparing the financial statements. So the basic objective is, of course, to try to reduce the subjectivity involved in the preparation of financial statements. To the extent possible, they should be neutral in character. Then the next comes reliability. Reliability of the financial information is very, very important. Unless the information is reliable, the information contained in the financial statement will not be of much help to the users of the financial statements. So reliability comes from continuing to adopt accounting principles in a fair and consistent manner. If accounting principles are applied fairly and consistently in the preparation of financial statement, they naturally tend to have reliability. So reliability is an important characteristic of financial statement. Then we come to prudence. Prudence means a degree of caution. That means while preparing the financial statement, you will have to keep in mind that some degree of prudence is essential. That means you have to ensure that caution is exercised in the preparation of financial statements. Normally what we do is, in the case of losses, we would like to account for all the losses even if they are not entirely probable. So that means we need to account for all possible kinds of losses which we may anticipate, but we normally do not account for incomes which we are likely to receive if there is some kind of probability involved in the accounting of incomes. Then we come to comparability. Comparability is another important characteristic of financial statements. What it means is, when the financial statements are ready for use, we should be able to compare the financial statements of an entity with the financial statements of the same entity for the previous years, or the financial statements of another entity operating in the same industry. So this comparability helps in the analysis of the financial statements, and this comparability characteristic can be built into the financial statements only if we are able to follow certain principles on a consistent basis. For example, if a company is following written down value method for calculation of depreciation, if they continue to follow the same consistently, then whatever information is contained in the financial statement becomes comparable with those of the previous years or with those of other entities following the same principles. Therefore, continuation of the use of accounting principles in a consistent manner is necessary. In case there is need for a change in accounting principles, the rule says that we need to disclose this so that the users of the financial statement will take into account the change in the accounting principle adopted by the entity and try to compare the financial statements with those of the previous years or with those of the similarly placed entities. Then the next characteristic is full, fair and adequate disclosure. Why this becomes necessary? What is the need for disclosure? The need for disclosure becomes very important because though there are certain accounting principles and standards which are required to be followed, there is a fair degree of options or choices available to the entities for preparation of the financial statements, and therefore the entities need to disclose what the basis for the preparation of the financial statement. For example, an entity has a choice of either following the straight line method of depreciation or the written down value method of depreciation. So if a particular entity is following written down value method of depreciation, it is fair that the entity discloses that it is following this particular method of depreciation, so that when we want to compare the balance sheet or the financial statements of one entity with that of another, this disclosure will be kept in mind and we will try to make adjustments in order to make them comparable. Therefore, full and fair and adequate disclosure. What it means here, the disclosures have to be full. Whatever accounting principles, whatever assumptions, whatever estimates have been made in the preparation of the financial statement, they have to be disclosed in full. They have to be fair in nature. Fair in nature means there should not be any need to hide any of the disclosures which are necessarily to be made, and they have to be adequate in nature. That means full disclosures have to be adequate. That means whatever needs to be disclosed has to be disclosed. Then we come to another important concept of qualitative characteristic of financial statement, that is called materiality. Materiality means something which has got a significant bearing on the preparation of the financial statements. Anything which is material, that is, which is likely to significantly affect the financial statements, need to be taken care of. If it is not material, then that cannot be ignored. To give you an example, let us say there is a balance sheet of a bank which is dealing in thousands and crores of rupees, and there is a small difference of 1000 rupees. That 1000 rupees may not be material in the whole context of the size of the balance sheet of the bank, So it becomes not material, that need not be taken into account or need not be disclosed. But let us just take the same example of a difference of 1000 rupees. If it is the financial statement of a small entity whose total sales are less than 1 lakh, then even 1000 rupees will make a lot of difference to the balance sheet or the financial statement. So what is material depends on the size of the entity or the nature of the business being done by the entity. So depending on that, we have to decide what is material and what is not material, and what is material has to be taken into account. So materiality has to be built into the preparation of the financial statements. Then completeness is another characteristic of financial statements. What it means is whatever information is available in the financial statement has to be complete in all respects, whether it is case of the profit and loss account or the balance sheet of the company. The information contained therein has to be complete in order to make it useful for the users of the financial statements. And finally, the last characteristic of the financial statement is called faithful representation. That means whatever is represented in the financial statement has to be done faithfully. That means there should be a question of trust in the preparation of the financial statements. Once all these characteristics are built into the financial statement, the financial statements which are then to be used by the users of the financial statement will become ready for use of the users of the financial statement, and they will be in a position to make informed judgments based on the information given therein. Therefore, it is very necessary that we take care of all the qualitative characteristics of the financial statements. Now we will go to another important section of this chapter known as accounting standards. As you know, accounting standards are the written policy documents issued by expert accounting body, government and other regulatory bodies. So before we come to the actual accounting standards, let us talk about the need for accounting standards. Why there should be accounting standards at all? As you know, when we want to build certain characteristics into the financial statements, we need to have certain basis on which the financial statements are prepared. If every entity is given the freedom to prepare financial statements as they deem it fit, then it becomes impossible for the users of the financial statements to study these financial statements and try to arrive at certain decisions or conclusions. Therefore, it is necessary preparation of financial statement is based on certain standards which are written down and which are uniformly followed by everybody. But unlike other areas, it is very difficult to bring in standards in all areas in accounting, basically because different countries follow different accounting practices and they have to conform to the different laws operating in those countries. And in addition to that, there are certain practices and cultures built into the businesses and they have to be following those. So in order to codify all the accounting practices and principles being followed throughout the world, it becomes difficult to develop standards. But it is essential that certain attempts are made in order to ensure that these accounting principles and practices are codified and the choice available to the entities in the preparation of financial statements is brought to the minimum as far as possible. That is what the accounting standards do. They try to arrive at certain bare minimum policies and principles so that the entities can use these policies in the preparation of the financial statements. Though it is not possible to rigidly arrive at a particular principle, it is possible to bring down the choices available to the entities. That is what the accounting standards have done. Now let us try to understand what these accounting standards deal with. They deal with these following issues. One is recognition of events and transactions in the financial events. How to recognize events and how to record transactions in the financial statement. That is important. To give an example, simple example, for example, when we make a sale, the sale has to be recognized in the books of the entity. How do you recognize sale? Whether sale has to be recognized when the sale is actually made or when the cash is actually received. What is the principle for the recognition of income? This is decided in the accounting standards. For example, there is an accounting standard dealing with recognition of income. There we try to find out as to what are the basis on which the different events and transactions happening in the life of an organization are recognized. The next is measurement of these transactions and events. As we have already seen, all transactions and events have to be measured in terms of money only, so that they can be recorded in the financial statements. So what this does is to ensure that the transactions and events are recorded in a particular manner in terms of money, and for that we have different concepts. As to what concept has to be used is decided under the accounting standards. For example, we can use the what is known as an historical concept. That means as and when a transaction takes place, the transaction is recorded at the cost at which it is obtained or at the cost at which it is incurred. This is known as the historical cost concept. Then the third is presentation of these transactions and events in financial statements. Ultimately, when the transactions and events are recorded in the financial statement, they have to be presented in a particular fashion. That presentation becomes difficult, so that the users of the financial statements can, by looking at the financial statement, get an idea of what has happened to the financial position or the summary of profit and loss of an entity. Then finally the disclosure requirement. The disclosure requirement becomes important because even though the accounting standards have been issued, still there exists a number of choices for the entities to follow different accounting principles and practices. And since there is a choice given to the entities, they need to disclose what type of accounting principles and practices are being followed by the entities. So disclosure becomes very, very important for the user of a financial statement, so that he will be able to make informed judgments. Now let us try to understand the objectives of accounting standards. One is elimination of the non-comparability of financial statements and thereby improve the reliability. What it means is, a two financial statements become incomparable if they follow different practices, if they follow different accounting principles and conventions. By trying to make them as uniform as possible, we are trying to reduce the non-comparability of these financial statements. Idea is to go towards that stage where they become strictly comparable with one another. But given the options available for the preparation of financial statements, it may not be possible to reach the full stage of comparability. So the idea is to eliminate the non-comparability clauses to the extent possible, so that the financial statements prepared thus are more reliable in nature. Second objective is provision of a set of standard accounting policies, valuation norms and disclosure requirements. In trying to do this, they are trying to ensure that the whole set of entities operating in the economy follow certain set of standard accounting policies, so that everybody knows the basis on which the accounting policies have been framed and how the financial statements have been prepared. The idea is to move towards that. There have been a lot of problems on the way in the preparation of accounting standards, and a lot of progress has been made so far. Now the next stage is set for trying to bring in uniformity across the countries. As you know, in India, accounting standards are being issued by the Institute of Chartered Accountants of India and notified later by the central government. So let us now briefly turn to the benefits of accounting standards. So what they do is, first of all, they try to reduce to a reasonable extent or eliminate altogether confusing variations in the accounting treatments used to prepare financial statements. That means what they actually try to do is to try to reduce the various options available to the entities in the preparation of financial statements. To give you some examples. One is in the method of accounting for depreciation. As you know, there are different methods of calculating depreciation. Two of the most important methods are, one is the written down value method, the second is the straight line method. Then of course we have other methods like the sum of years, digits method and so on. But if each one of them tries to follow his own method, then it becomes difficult for the users of financial statement to analyze or interpret the results thereof. Therefore, they try to reduce to the extent possible such options available. Similarly, in the matter of recording of foreign exchange, foreign currency transactions. For example, the entity has exposure in other currencies other than the home currency. For example, an Indian businessman having exposure in dollars. When he prepares the financial statements, the foreign currency transactions have to be converted into Indian currency. At what rate it has to be converted? Again, there could be a lot of leeway available to the entities. So, accounting standard on such thing enables him to bring down his choices to a set of choices, and these choices are made available to all entities, so that we are able to bring down to a reasonable extent the variations available in the matter of accounting. Then second is calls for disclosures beyond that is required by law. So, mandatorily the laws of the country mandate that certain disclosures are required to be made by the entity at the time of preparation of the financial statement. For example, Companies Act mandates that certain disclosures need to be made in the financial statements. So, accounting standards go beyond this, they call for even more disclosure than are required by law, so that there is some kind of compulsion on the part of entities to disclose in a fair and full manner whatever is required to be disclosed, so that the financial statements become amenable for better interpretation and better analysis. And lastly, the third benefit of accounting standards is facilitate to the extent possible comparison of financial statements. As we have said earlier, this is also one of the objectives of financial statement. They enable the comparability of the different financial statements, or to a large extent ensure that there is some kind of level playing field between the entities in the matter of preparation of the financial statements. Now, let us consider some of the limitations of accounting standards. Though there are certain benefits, these benefits also go with certain limitations which are there on account of the very fact that accounting standards cannot be very rigid. That means a lot of choice is given to the entities in the preparation of financial statements. So, when the choice is given, what could be the extent of choice, and how can we expect entities to adopt one of the choices available there? So, that becomes difficult. The choice of different accounting principles becomes difficult for entities. The accounting standards, in order to ensure they have certain uniform practices, they tend to become more and more rigid. That means the choice available to the entities is taken away. That means we are moving away from flexibility towards rigidity. This is one of the most important limitations of accounting standards. So, we are trying to ensure that all entities fall in line and do a certain thing only. So, this may not be in the best interest of the entities. And the third important limitation of the accounting standard is they cannot override the statute. That means they have no say over the statute. If a law in the country states that it has to be done in a particular manner, irrespective of what the accounting standards say, the law has precedence over the accounting standards. So, this becomes one of the important limitations of accounting standards.